13 most important charts that you should know as an investor. That's what we are talking today on this channel. Thanks for joining me. And at this point, you're probably, somewhat connected to investing in individual stocks, indexes, and maybe you are wondering that, maybe you're in your first year, 2 years, 3 years, and it's starting to go somewhat reasonably, but you still don't see that, like a proper compounding over the years. But it's super important to stay patient, right? Because if we start directly here with the chart one, this basically shows total real returns on US stocks, bonds, bills, gold, and the dollar, all the way from 1800s to 2012. And what this shows you is basically that the stocks are always superior. Of course, there will be peaks and valleys, but overall, it's the greatest wealth creation machine there ever was, right? Compared to, on the maybe like the second rank, you would have bonds, bills, not bad, but the stocks are always superior, right? And maybe you are wondering, like, why is that the case? Why are stocks such a great wealth creation machine? Well, in order to realize why is that, we have to understand how businesses work, right? How businesses operate and what makes them intrinsically valuable. So, of course, when, people set up a company, they produce goods and services for other people, they work, they basically provide for others, and more people work for the company, they produce more products over time, and they become more valuable, right? So, maybe you might have bought a stock, let's say 2, 3 years ago. And in the meantime, the company, hopefully, if you've chosen right, is getting more and more valuable because it gets bigger, it gets more important, it gets more efficient as well, right? So the value of the company grows and grows and grows. Whereas, with things like gold, it's in a sense, it's just this, object that you just kind of dig from the ground and maybe store it somewhere in the safe, right? So there is nothing that's really making it more valuable over time. Sure, it might somewhat protect its value over time, which, it basically did a little bit, right? But it's just that store value. It's not that multiplication of value. But of course, with stocks, it also comes to that small details that we need to be a little bit more careful and little bit, know what's going on, right? And how our business is becoming valuable and choose those businesses, right? So we are making choices for our portfolio, for ourselves, want to make that nice lineup of, maybe 7, 9, 12 companies that will do better over time, right? So hope that stays with you. Stocks always superior, but you have to be careful. You need to know what you're doing. And now the second most important chart, and that obviously shows you the difference between the bull markets and the bear markets, right? And as an investor, maybe if you are in your first, second, third year, and I've been in the market for about 7 years, so I've been through some of the things. Obviously, not as someone who's been in the market 15, 20 years, but I mean, especially the last 3 years were pretty much out of ordinary, right? With the first COVID drop, then the pumping of the economy all the way almost to the moon, then the long bear market of the last year. Now it seems like we are getting out of the worst again. Nevertheless, right, if you look at the again long time statistics all the way to 1950s, the bull markets are always long and long and long, and you just get wealthier and wealthier. And of course, there comes these short periods of the bear market. But basically, if you are long stocks, if you are bullish, you will be roughly correct 4 out of 5 times, right? Most of the years, the market ends up in the green. Bear markets are usually a little bit more vicious, but they don't last so long, right? It's usually a year, maybe maximum of 2 years. But after that comes, 3, 5, 7 years of basically bull market, of a nice positive period. So, we just have to always be able to stomach these, 30%, 40% drops every once in a while. And it feels super bad, right? Seeing your portfolio drop 30, 40%, maybe more, especially if you are choosing individual stocks, right? That gets even trickier. And I don't think people talk about this psychology of investing enough. But as long as you can survive these periods, then you will become much, much wealthier during the bull markets, right? So always remember that. And let's go for number three. And this shows a little bit similar, right? Because also you've probably heard that, okay, on average in the stock market, if you invest in an index fund, maybe you get those 6, 7, 8, 9%, depending if you count with the inflation or without. But there are actually so few years that end up in that, point something or, 4% plus or 7% plus. That's just this middle column here. But most of the years, it's going to be either much worse or much better, right? So, last year S&P 500 basically dropped, I don't know, 20% or something. This year we are again like 20% up. So it's it's never the calm sailing in the market, right? You really need to be able to experience both the negative and quite severe. But there are also, so many positive years, 2003, 1954, 2019, great year, S&P 500 up 30%. And you didn't want to miss those years, right? Like imagine you just stayed out of the market for this period and you would miss those 30%. So that's why you also want to be, invested for the long term, most of your portfolio, quality companies and just holding them, right? So as you can see, there were basically like a 72 positive years and 24 negative years. So yeah, as long as you are long, you will do just fine. And let's go into the number five. And what's a little bit sometimes troubling, right? Because these days information is like super abundant, right? And you are on Twitter slash X, and there are plenty of people on YouTube, and then there is a CNBC, and Jim Cramer is talking about this, and then there are these people on YouTube, then there is me, and everyone is talking about this stock and that stock, and you know that kind of pushes us a little bit to just like trade in and out and hey, maybe there is this new stock here that maybe I should be invested in, or oh no, this guy is talking about this stock, so maybe I should sell out of this stock and go into this stocks. But we have to remember that like this trading in and out, who does that benefit? Well, that obviously benefits all of the brokerages, banks and everything. They are pushing you to basically be active in the market and the media, right? They want you to click, they want you to, listen about this new company or that new company. So there's always something going on and everyone is collecting the fees along the way. Those people don't get money from someone who just like buys the stocks and holds it for 3 years, right? Like where is the money made in there? And so basically, if you would go back to, 1940s, 50s, 60s, even 70s, usually people were holding stocks for a long period of time, which also comes down to obviously back in the days, it wasn't as easy to trade in and out, right? You needed to either go physically somewhere, get, the stock certificate. Later, you need to call your broker, hey, I would like to buy X amount of XYZ stock, get him to basically execute the trade. And then, of course, once somewhere around, 2010-ish, after the financial crisis, there was the, new brokerages, basically, trading without the fees, Robinhood, all of this stuff, which, it makes it so freaking easy to invest these days, or more like trade, right? You just take your phone, super easy. Like I can basically, if I want, today I can like literally as soon as the market opens in 30 minutes, I can just click sell out of my whole portfolio and I can buy like completely different stocks. So makes it super easy, but also that's not where the money is made, right? So especially because these days, it's everyone is trading in and out, there is lots of alpha to be captured if we are just being a little bit more patient. So please be a little bit more, mindful when you are doing anything in your portfolio. Because also, the less thing you do, the less opportunities to make a mistake. As a long-term investor, you just want to be basically right ones. You just want to be directionally correct, right? From the point where you buy the stocks and where it's headed over the next, 3, 5 years. And if you get that right, you'll do great. And let's jump into the number five, I think it is five. So, and also a lot about psychology in the market, right? And we've seen this chart play out to the T, especially, in 21, if you've been in the market where everyone was, the Fed was pumping liquidity. everyone was, just basically getting money from, all of the COVID stimulus checks and everything. So, everyone was, at home, nothing to do, just, trading stocks again, which kind of ties what we talked about just a little bit before about, just being super active in the market. So they pumped some of these companies to insane valuations, Zoom, Robinhood, and obviously the most craziness with the GameStop, AMC, and everything, right? So, this was basically like this point here, that was somewhere in the 21, everyone was super optimistic. And then over the past year, so many companies basically, declined 60, 70, 80% from these highs, even quality companies like Meta, right? So, such a quality company, but nobody wanted a piece of Meta those 10 months ago, right? But the people that understand these market cycles and are able to maybe detach themselves a little bit, so that's what I want you to do, and really, whenever you are making a decision in the stock market, really look, and for that you need to be a little bit more advanced investor, understand the valuations, not just the stocks from the qualitative perspective, but also from the financial aspect. So basically dive a little bit deeper and understand, if I'm buying this company today for this price, for these multiples, is it more somewhere here, or is it actually here? Is the company undervalued? That's where, obviously you can outperform market with a wide margin. You'll do fine if you're buying quality companies over the long term, company like Tesla, let's say, whether you were buying it, a couple of years ago for 50, 10 months ago for 100. If you are buying now for 200, you'll still pretty much, in my opinion, do quite well over the years. But of course, someone who can, understand the valuations on a deep level, they will do much better. So a little bit higher level, but that's a challenge for you. And then number 6, reason to sell, right? And oh my God, like last year was especially, crazy about this, right? Everyone always have a smart opinion to sell. But all of these reasons to sell, they sound super smart, but they lead nowhere. They lead out of the market. It's like you're on a highway, you're driving, 90 miles per hour, and you want to get to your destination, right? And whether that destination is a million, 2 million, 10 million, it's your destination. So why would you get out on this exit, right? And then what you do, you just like stand there for a while and you just delay getting to your destination, getting to your goal. So if you would go, and this is just, since the financial crisis, basically, right? There was lots of, S&P downgrades of the US debt. There was the government shutdown in 2013. There was this short period of, different kind of the healthcare crisis over the year. I don't even want to say it, or I will be, demonetized or whatever. And, then some quick Nasdaq falls. Then if you remember in 2018, there was the trade war, kind of with the China situation was a little bit hairy. There was a yield curve invasion before the whole, Rona jumped us in 2020, the whole crash again. But then the market, recovered super quickly. Now, obviously, we are having super, the interest rates are super high. Another very smart reason to sell. There was the war, with Russia, Ukraine last year. Also, like everyone, like so many people were telling you, oh my God, it's the war, like sell off everything. This is going to be a huge crisis. And how did the market perform since then? Well, obviously, it went down. It went down for some time last year, but this year the war is still there, and everything's like super tricky in that region, right? But that's the old news, right? But this year the market's been performing quite nicely, both Nasdaq, S&P 500. So there is always something happening around the world, something that can push you to maybe sell your stocks. But in the end, it's not worth it. And connected with that, number 7, how much do elections actually affect the stock market? Well, in my opinion, don't mix politics and the stock market, right? Because in the end, I mean, both sides of the aisle, whether you are more of a donkey or an elephant, they all want the stock market to perform nicely, especially under their wings, let's say, right? So basically, as you've seen, it really doesn't matter who was in the office. Some of the periods were a little bit, more optimistic, some of them not so. But hey, maybe you can a little bit play the sides, maybe different sides have, make different sectors a little bit more advantageous. But in the end, the markets, moving forward, whoever's in the office. So, discuss politics, but don't mix it with your investing. Simple as that. And number eight, holding period per years and how does this influence the valuations, right? So, obviously it's also important that as a long-term investor, the most effect on the stock performance is mostly the revenue growth and only slightly the margins, multiples. But as long as basically, hey, from the point you bought the company to the point where, into the future where you are eventually planning to sell, maybe a couple of years down the road, as long as the company is getting better, getting bigger, producing more revenue, you'll most likely do just fine, unless like a significantly overpaid in the first place, which kind of ties us to, what drives the stock price in a short period, right? In a 6 months, in a year. And then it gets a little bit more tricky, right? Because there is definitely, free cash flow to take into an equation. Multiples drive companies a lot in the short term, right? As an example, Meta 10 months ago got compressed to basically like a 10 forward P or something around these lines, which, for anyone who understands financial ratios to at least some degree, understands that, hey, 10 P ratio is definitely a very low number, mostly assigned to companies that are not really growing anymore, or, just really growing low single digits. But hey, that wasn't the case for Facebook, right? So there needed to be a couple of almost like, just promise that, hey, we understand what's going on, we will fix it, we will come back to printing money. And basically just that flip of it was just the story and it was just a promise that it will get better in the future, right? And the stock price rapidly appreciated, basically 2x and more over, just a couple of months, right? Almost no one expected such a quick recovery for Facebook, but it happened, right? So once again, in the short term, just make sure that, your company is not overhyped, so you are not overpaying. But in the long term, really, just make sure that the revenue growth is there. Because as long as the revenue growth, from my experience, from my 7 years in the market, the bottom line often fixes itself, at least to some extent, right? Obviously, there are companies that will do it better, there are companies that will do it worse, but it's that more fixable part of the equation. But company needs to grow the revenue in order to be able to do that. So that was number eight, and let's get into number nine. Oh, I love this one. This is super important. If you're building your portfolio, if you are in your first, second, third, fourth year of investing, relevant nevertheless. And as an individual investor, you probably have somewhat limited time, right? You don't have the, like 8 hours a day to spend with investing, researching companies. So you want to be somewhat mindful of your time, right? We have our work, families, hobbies, and whatnot. And so we want to make sure that we spend like a reasonable amount of time with investing, right? And on the other hand, we should spend at least a few hours, right? Everyone can find maybe 4 or 5 hours every week to take care of their portfolio, and 4 or 5 hours, decent amount. But hey, as long as you can do that, you can definitely outperform market with a decent margin, right? But to do that, you also need to have a portfolio that's somewhat nicely structured, right? Obviously, when we are just, and so let me just basically explain what this chart shows you. On the horizontal axis, we have number of stocks, 1, 20, 200. On the vertical one, we basically have the risk. So what this shows you is that there is always a market risk, right? Whether you have 3, 5, 20, 200 stocks, if the market goes down, it goes down. If it goes up, it lifts all of the boats, right? That being said, of course, if you are having 1, 3, 5 companies, that's definitely risky, right? If you have 4 companies, one of them goes down, hey, that's 25% of your portfolio evaporated, right? But then again, once you are crossing maybe those 15, 20 companies, adding more is not necessarily, protect you more in terms of diversification. It just gives you more headache, right? Because you have more companies to keep track of. So basically, kind of like the sweet spot that I would consider, and what I'm trying to, also have for my own portfolio is somewhere between those 8, 12 companies, at least when we are talking for portfolio under 1 million. Maybe once you have those 7 figures, it starts to be diversification a little bit more important. Then you can take it all the way to, 15-ish, 20. But the more companies you have in your portfolio, the more information you need to, store in your head, or somewhere in the spreadsheet, make notes, understand which company have you bought for whatever reason. So keep it simple, especially under 6 figures. 5, 6, 7 companies work perfectly fine for me. So let's just keep it freaking simple, guys. And number 10. So what this shows you is obviously the distinction between the stock and the company itself, right? As a long-term investor, you should come from a mindset of an owner, right? When you buy a stock, you are part owner of the company. And the business, there are not so much fluctuation with the business. Obviously, there, depending on the business, there is some seasonality. Some years are better, some years are worse. But in general, quality companies will just kind of, slowly inch, become better, more valuable, grow their revenue at somewhat, linear or slightly exponential manner. That's not the case for stock price, obviously, right? Depending on the macroeconomy, overall mood, narrative about the individual company, the stock price can fluctuate and fluctuate a lot, right? So, of course, on a like a deeper level, you want to be able to distinguish when the companies are undervalued. So, maybe let's say, like this is a real stock chart, not just like some kind of drawing that I came up with, but basically if you want to, be on it like a higher level investor and you want to accumulate position in this company, you research it well enough so you understand that, hey, in this point, this point, this point, also these points, it's definitely undervalued, right? So maybe I want to keep adding to my positions and don't add when there are these, peaks, when it's maybe a little bit overvalued. You can potentially sell part of it if that's more of your style, but for me it would be just, kind of trying to accumulate over a long period of time. For example, maybe, personally with Palantir, I was buying a lot back in 21, regardless if it was at 9, 7, all the way down to 6, or once again to 8, 9. So I kind of have a range that, okay, at this price Palantir is definitely significantly undervalued. That's when I love it, I will keep buying repeatedly. Now at 15, okay, that's a completely different story, right? Maybe I still want a little bit of Palantir and I still see very much bright future ahead of it, but I don't want to invest that aggressively anymore, right? Maybe I nibble a little bit here and there, but that understanding that on the short term Palantir is maybe a little bit ahead of itself, that's what makes us a little bit more like a sophisticated investor. Oh yeah, and number 11. This is an important one, so pay close attention. Compounding, as Warren Buffett puts it, that's the eighth wonder of the world, and it's sometimes hard to feel it. Let me explain. So basically, when I started investing back in 2017, and I was just putting some money in the index fund and a couple of those big known companies such as Apple, and I started to put a few hundred in the market, and it grew to a few thousand. But at the beginning, my portfolio was like a little bit inching up nicely, and let's say you have a portfolio that's maybe like a 5,000, and you get your first, like a 10% return, so you have, basically like a 500 of gains. Hey, that's nice, but it's still, just another 500. It's great to have it, right? But it's, like, is it worth it, for all of the, our effort, attention that we are putting into the market? But then you kind of, continue adding more into portfolio, maybe, hopefully regularly, every month, every 2 weeks, another few hundred, 1,000. And then, maybe somewhere around your third, fourth year, suddenly it starts to, grow and grow, kind of almost feels faster, right? Because, you are basically getting the returns compounded, right? So suddenly, if your portfolio grew 10% last year and then maybe 15% this year, it's suddenly becoming more and more. And if you extrapolate it far, far into the future, like the difference between being, you know, let's say this is just basically kind of like a model scenario, having 30,000 invested and adding another 1,000 I think into the market every month. And if you just get those 10%, just like slightly beating the market, you might get to 500,000. Okay, freaking amazing, good for you. But hey, if you actually spend some time and effort and actually understand what you're doing in the market, right? Then maybe you can get up to 15%. If you're, really dialed into the market, understand the valuations and everything, you can probably get somewhere close to 20%, right? That's a little bit higher, aspirational, yet still definitely achievable rate. And okay, over the 15 years, that's the difference between getting your portfolio to 500,000 or 1.2 million. Okay, that's suddenly a huge difference, right? And that's just for those, few extra hours spending every week. So after that, like if you continue doing this over the 15 years, you will well realize it was worth it, right? By that lift experience. But when we are still here in the beginning phases, it's sometimes hard, right? Like the dedication, investing every month, getting being kind of like a reliable, having that almost agreement with ourselves that hey, I'll be patient, I will put that money into the market so I can have really bright future. All of the options will open to me once I cross that 1 million, maybe two, maybe four, depending what's your number. If you have a number, maybe it's just a challenge for you as it is for me, but hey, this is what we want to get to. And let's jump to number 12. Okay, this is interesting one. It's maybe almost like a little bit side note, but there will be a lot of people that will be telling you, "Oh my God, the stock market is so overvalued these days." Like the average P ratio from like 1950s to 90 to 2000 was at this level, and now we are at this level. That means the crash is imminent, and you should sell all your stocks, buy gold, buy shotgun and shells, and uh, make a bunker or something. There is one important caveat to that. Let me explain. So basically, obviously, if you're at least somewhat a little bit older, you probably remember, or at least you've heard about obviously the dot-com bubble, right? Amazing period with the basically internet coming to fruition, lots of crazy things in the market, big basically bubble, bust, and everything. Nevertheless, right, like plenty of the companies basically survived and it created this environment of the internet connection. You're obviously watching this on YouTube or X or everything. And what does that mean? Well, net income margin, basically median over the past 60, 70 years was somewhere around 8.5. But since the kind of like the widespread adoption of the internet, the net income margin, kind of the average for the companies in an S&P 500, it grew to 15%. So what does that mean? Like all of those companies that we are talking about, they are almost 2x profitable compared to all of this period before, right? And is there any reason why that should reverse? Well, I don't think so, right? Especially now with the AI coming to play, which is making all of the companies even more efficient, right? Like everything is super simple these days, right? With, simple video, you can, reach a couple hundred of people, maybe 1,000, maybe a few, tens of thousands, some people even millions. And same goes for companies, right? Where, 20, 30, 40 years ago, you needed, 10 employees to do a certain amount of work. Now maybe you need 2 employees, which, obviously makes us all richer in the end. And another reason why I invest in the stock market in the first place, right? It's such a great wealth creation machine. So again, remember this chart. Someone tells you the stock market is overvalued. Okay, so number 13. This is also one of the important ones to also sometimes remember when you are, putting your own money on the line, especially, in some of those periods where everything's flying high, be a little bit mindful not to overpay, right? Because, you know, the percentages are a little bit misleading, right? If your company loses 50% of value, in order to get where you were, you don't need up for 50%. If you do another 50% up, that would just mean you get to 75% of your original value, right? See how that works? So if your stock actually declines 50%, you need it to double in order to be very aware. And of course, even worse, right? If your company declines 80%, you need it to 4x to basically get very aware. And that's why it's super important to understand valuations on a high level. Of course, if the company declines 10, 20%, that happens. But if your company declines, more than that, unless it's like a very volatile stock, you know, for example, Tesla is very volatile, Palantir is also very volatile. These are a little bit of an exception. But especially if we are talking about more mature, bigger companies, if they decline, 40, 50, 60%, you might have had made some mistake, right? So, as long, if your company declines 10, 20, 30, there's obviously some wiggle room in the valuation. Nobody ever gets it correctly. But if it's 50, 60, 70, you probably don't want to repeat that mistake, right? So that's number 13. And there is one bonus, of course, just because I love you guys. So I've also prepared number 14, and that's a little bit for the younger people that are hopefully still watching at I don't know 20, 30 minute mark. But the sooner we start with investing, the better, right? Because let's say you just get those 8% that you just want to take it easy, put the money in the index fund, expect those 7, 8%. Well, that means if you put $1, if you are, let's say, 20 years old, somewhere here, 20 years old at 8%, putting money into index fund, that $1 grows to 21 by the time you are 60. So the money is especially very valuable for you when you are young. It can grow, to some really unreasonable number. Even let's say if you are 30, putting a dollar into market, and of course, put some bigger numbers there, right, to better understand it. Let's say you are 30, you put 10,000 into the market. Hey, by the time you're 60, that 10,000 is going to be 100,000. That 100,000 is going to be 1 million. So, of course, enjoy your life as much as you want. But if you want to especially enjoy your life, have more opportunities down the road, make sure you're investing, in some of those old books, they tell you, hey, at least 10% of your income invested. I would be much more aggressive. Let's a little bit challenge ourselves. Let's do at least 20, 30%. If you can do 50%, freaking amazing. You will do so great in the market. You will achieve everything you wanted and even more. But you need to have the discipline, have the patience, and that's all I have to say for you, right? It's a little bit painful, but damn, it's fucking oh damn, I need to beat myself. It's freaking worth it. So hey, thanks for staying with me. Definitely subscribe, follow me on Twitter, X, whatever. Thanks for staying with me. Love you guys, and yeah, that's all from me for today. So take care.